This is us. So we have John Palumbo from Round Point Mortgage. You have me, Aretha Busby with eXp Realty, and you have Gregory Byrnes at Davis and Byrnes, and he's a principal attorney there. All of us are licensed to transact and help you with your purchases in both New York and New Jersey. Okay. And that's our information here, our phone numbers. And once again, you're going to see our information again at the end too. Okay. So, oops, sorry, I'm having some issues with my mouse here. So the first question is property ownership even for you? I mean, depending on what your current situation is, there's a lot of things that you need to consider when you're thinking about purchasing a place. It's not for everybody, but it's a great way to create wealth, to add some stability to your life, and to also just give you an anchor in your community. So there's lots of wonderful reasons to become an owner. But, there are some steps that can be more challenging than going and renting a space for yourself. So, I put this image there because I think a lot of first-time buyers are overwhelmed at the process, especially in New York. It's very competitive, and you can feel sometimes like you're too small and that you're never going to be able to get a place. But we are here to help you, help you make it possible. Let's see if I can get to the next slide. So, okay, oops, sorry, my mouse is a little sensitive. So I've outlined here in a few steps the purchasing process. I did a more in-depth class a few weeks ago, and we'll be doing them again on the entire process. But this is a graphic that I shared then, and I just think it's very helpful to let you know what all of your steps are. Notice that step one is to really find a lender, and this is where John's role is crucial. I should also point out that I've closed deals with John and with Greg, so we didn't just grab some randos, out of the phone book to bring here. These are people that are, tried and true professionals that are sensitive to, what your needs are as creative people in, the tri-state area trying to purchase property. So starting with the process, we always say start with a lender, find a realtor that hopefully Michele or myself that you would want to work with. Identify your housing criteria, begin your search, you make an offer, and once your offer is accepted, you would contact your lender again, let them know you want to lock in an attorney, and that's where Greg comes in, and then you schedule your inspection, right? You then would satisfy your contract terms, prepare for closing, you do your final walkthrough, and then you close. So the interesting thing is for, Greg, John, and I, or Greg, John, Michele, and I, because, she's also a licensed real estate agent, we are in the transaction with you from the very beginning to the very end. There will be other players that kind of bob and weave in and out of the process, the appraiser, the inspector, and things like that, folks like that. But it's your mortgage person and your attorney and your real estate agent who, based on, what your buying power is, what kind of property you're trying to get, who, if anyone, you're purchasing the property with, we will help to make the whole transaction happen for you based on those things. And so, having John is the first person in the process. So I want to hand the reins over to John. Oh, sorry, I gave you some ideas on choosing your realtor. Sorry. Before we go to John, picking your real estate agent, here are your points. You want an agent that is, understanding what your intended use is for the space, understands your budget, has knowledge of the property market in the area, your area of interest. If you want to be in Queens, you don't want to focus on an agent who only has done deals in New Jersey or, in Staten Island. You want to make sure that they're very familiar with other deals, that have happened in your price range. You really want someone that's going to listen to your needs and hear your concerns, and that's a great communicator. and also that's keeping your best interest in mind. Sometimes you will think you're just going to call an agent that has a listing and that they're going to show you the space, and that can happen. But oftentimes, they're prioritizing the seller and maybe not you. So you may want, someone that just represents your interest in the transaction. You also want to reach out and, lock in an agent that has partners and resources that can help you to make the process easier. Every qualified agent should be able to recommend an attorney, appraiser. Well, not so much an appraiser because that comes from the bank, but if you needed an appraiser and you're not getting a loan, an agent should be able to help you with that, but also an inspector, and maybe even contractors if you're going to need that too. And with that, I'm going to hand it over to John. To the next slide. There's my information. Need it?
Okay, thank you so much, Aretha and Michele. Thank you for having us. Real pleasure to be here. So just a quick background on myself and what I do. So as Aretha mentioned, I'm a mortgage banker. I've been in the business now well over 20 years. I started real young, and I've closed thousands of transactions throughout my career. And I mention that because I've had the opportunity to see every kind of scenario that's kind of thrown at me, and it can, some are very, very challenging. That we see, but nonetheless, my job is to, really educate my buyers. I love working with first-time buyers, even those buyers that have a lot of experience. There's so much change in this market and the dynamics of guidelines and programs that are out there. And really, it's to try and find the best product that's out there that's going to save you the most amount of money, but ultimately also get you into the home. Okay, so we'll get right into it. And I'm just going to touch on some of the major, some of the main points that I want you guys to take in from this presentation so that when you go in, the buying process can be, sometimes give you some anxiety. You'll have a lot of questions, especially as a new person buying for the first time. There's a lot of unknown. And really our job is to kind of walk you through that process from beginning to end, like Aretha said, and try and make it as easy and make you understand the process from beginning all the way through to the closing. Okay, so I'm going to get started with the very first step is really getting your pre-approval. As Aretha mentioned, you want to speak to a lender right from the very beginning, because that's how you're going to know what your buying power is. You want to make sure you're working with a real estate agent. A real estate agent wants to make sure that she or he is showing your property that is within your budget, so they'll narrow it down to a particular area that you should be looking in based on maybe what the prices are, what the taxes are, what your needs are. So it's very important to understand how high you can purchase. Also, you have to go in strong. Today's market right now, it is a seller market at this moment. There's a lack of some inventory. So as a buyer, you really have to go in prepared, and you have to go in strong with a pre-approval letter in hand and be ready to make a good solid offer and be ready to move forward. Okay, so pre-approval is your very, very first step that you'd want to to get yourself started. So some of the documentation involved here, we have the three main parts of the pre-approval. You have your credit, your income, and your assets. And I'll touch on some of these points, but mainly these are the three parts of a traditional type mortgage. And I'll touch upon some other types of loans where, being an artist or being self-employed today, you may not qualify for a traditional type mortgage. And that's where we have our non-traditional called non-QM programs that we can also fit you into. So again, my job really is to analyze your situation, ask you the questions. I would do an interview, ask you the right questions, and then from there, determine what is the best product for you. Work history is very, very important. And again, the three parts, credit, income, and assets, we will analyze, and I'll touch on these points. And next slide, Aretha. Yeah. Okay, these are just some other points. The appraisal title, some things involved as well. Okay.
Oh, I can go back.
You're good. You're good. Thank you. You can move on to the next one. Yeah, move forward. Thank you. Okay. All right. So these are the main documents that you want to always be prepared to come in with. Okay. So, and our job always will be we really try and simplify, and we try to keep the paperwork to a bare minimum, but these are the main things that a lender will always ask you for. We'll ask you about your job history. Okay. How long have you been on the job? We'll ask you to always provide, if you're a W-2 wage earner, for example, we will ask you to provide two or three recent pay stubs. We're going to want to see your W-2s. Your self-employed borrowers, we will then want to see more so your tax returns. whether you have business returns, personal returns, the tax returns are very important. And what I want to say about that is if you're going into the market to purchase a home, it's very easy as a self-employed borrower to write off a ton of expenses. But what you're doing there is you're cutting your income down to nothing. The more expenses you write off, unfortunately, yes, you pay less to the IRS and you may have legitimate expenses, but keep in mind that we look at your net income after your expenses. There's certain things that we can add back. Okay. So if you're going in to buy, definitely important to try and avoid too many expenses that may be unnecessary that you can avoid. Okay. Because that will hurt you when you're trying to purchase a property. Bank statements. We're always going to ask you for at least 1 to 2 months of bank statements. Assets are a very, very important part of the transaction. And one of the most challenging parts really is sometimes someone that has the money, but they really don't have it in the bank, or they don't have, they have it somewhere. It may be in a safety deposit box. They may have cash at home. They may be getting it from a relative. There's a proper way of handling things like this, like a gift, for example, is allowed on a lot of transactions, but we have to be very cautious with how we handle cash deposits going in. And that's one of the biggest challenges that I see, trailing of money. A lot of times unfortunately, before someone comes to me, they've already moved money around. They've made large deposits in their bank account. And generally, we have to have the money sitting in their bank account at least a couple months before we can even do anything to be able to use those funds. Okay. Some of the extras you have, if you're divorced, we'll ask you for a divorce decree, evidence of child support. If you are receiving alimony, child support, that's extra income that we certainly can use. Okay. You also have student loan payments that we question. We ask you whether or not student loan payments are deferred, or are you on some type of a forbearance plan, or are they income based? These are all the questions that we ask when we're actually qualifying you for a mortgage. Do you own any other properties? Have you co-signed for someone? Co-signing is a big part of this as well. And you may have very good intentions of helping a sibling, a child, anyone in your family as a co-signer, but definitely keep in mind that if you're co-signing for someone, that is a debt that you're obligated on, okay? And it will count as a debt against you, and it will have to be accounted for. Now, with that said, if you've co-signed for someone and we can show proof that the other person is making payments on that for at least 1 year, then we can ignore that as a debt against you, okay? So you have to give yourself that 1 year notice of time that we can definitely eliminate that as a debt against you. And also letters of explanation. We need to paint a picture for an underwriter. We have to explain why, for example, you're looking to move into New York City. You're looking to maybe relocate. There's always going to be questions that come up in underwriting. And it's not that we mean to interrogate you, but it's part of the process. We will unfold, your life story. We need to know. And I always tell my clients, definitely be upfront with me. Let me know everything that, be honest, because we're going to find out anyway. If you've co-signed for someone, if you've, put your name on something, we're going to see it. Today, the banks are so sophisticated with their systems that I could tell you, who lives in your house, who the utilities are under. I could tell you where you've lived, past names that you've had. We see all this. We run all sorts of, and not to scare you, but point is we really unfold everything about the individual. So we really have to have a very trusting relationship from the very beginning. So that way, if something is going to be an issue, I can address it from the very start. Okay. All right. Next slide. This is a very important one. Credit. There's many misconceptions about credit and how credit works. And, you have those borrowers that always pay everything on time. They're always on time. They've never missed a payment, ever, but they can't get their score up to that high tier. Credit scores range all the way from the lowest I've seen is probably in the upper 400s, all the way up to the 800 range, which is the highest tier. Once you're above a 740, that puts you in the best tier. And what does that do for you? Being in the highest tier on credit, like anything else that you shop for, whether it's a credit card, a vehicle, a lender, whoever's giving you the loan will always give you a better rate, better terms if you have a higher credit score. It just shows that you're more responsible with paying your bills and you're more responsible with managing your credit. And at a very young age, if you can, start very young with building credit and maintain it, it's going to help you so much in the future, whether you're buying a car or applying for a credit card. Credit card, you may pay 6-7% interest rate versus paying 15% or 18% interest rate with a low credit score. Sure, you'll get the credit card, but it's how much you're going to pay to have that card. Same with mortgages. Someone that has a perfect credit rating that comes to me, I'm able to get them the best terms that are out there in the marketplace. Somebody that has more challenged, credit, I can still get them into a loan, but it's going to be more of a cost to that borrower, because that's how the market works and how things are based on levels of risk. Okay, so these are some of the types of credit that you'll see on your credit, how it's broken down. You have payment history, what you're paying on time. Are you derogatory in any accounts? Making a late payment on a credit, collection pops up, can drop you 50 to 70 points at a time. Okay, and it takes time for your credit to recoup. Amounts owed. This is one that many people miss. Again, they make perfect payments, but what happens is they're maxing out their credit cards. Rule of thumb that I will share with you is that if your credit card, for example, has a limit of $1,000, don't use more than $300 on that account. If you use more than 30% of it, your credit score starts to drop down. Okay, so that's a very, very important point to know and understand, because even paying everything on time still can mean your scores will drop. Okay, length of credit history. Important to keep your accounts open as long as possible. Keep the accounts as, even if you're not using them, on occasion, use them, buy gas, pick up a coffee with your credit card, because that long history helps build your credit. People make the mistake of saying, oh, I don't use this credit card, I'm just going to close it. You don't want to close credit. You want to maintain it for as many years as you can. Okay. New credit initially will drop your scores down, but with time, as you keep that card open for years and years, it's going to give you a perfect credit history. Okay. And lastly is the types of credit that are out there. Types of credit involve, you have mortgages that appear on credit. You have student loans that appear on credit. Revolving accounts. Revolving accounts means credit cards, any type of store card or any type of credit card. Debit cards don't appear on credit. A debit card is linked to your checking account. That's not something so sometimes people think that they're establishing credit with a credit card. They are not. Okay, it has to be an actual credit card that reports to your credit. And also there are installment loans. Your vehicles, if you take out some type of an installment loan, that's basically paid in installments, and then once it's paid off in full, it's closed. Okay, revolving account means that you can continuously use it, pay it off, use it, and pay it off. So that's the main difference. Okay, so these are some really good points in how to keep that credit score up. Okay, and again, keep the balances down, utilize the credit, use it on occasion, even if you don't use it, much, but keep the accounts open and definitely pay everything on time. Very, very important. Now, last point on that, if you are having a hard time getting credit because you have zero credit, you've never opened up a credit card, okay, you can go to a bank and ask for a secured credit card where you'll give them a deposit and they will in turn give you a credit card that you start to use. Okay. And it's almost like having a security deposit. So if you default on it, they have your money. Now, if you use it as a regular card and maybe 6 months pass, everything's been on time, they'll release you your deposit back and you continue to use it as a regular credit card. Now you have scores built and now you can continue to get credit much easier because you have a history established. Okay. So just some good points there. Go on to the next slide, Aretha. Okay, so self-employed borrowers versus wage earners. And the reason I wanted to touch on this is because many of you on this call, being artists and work for yourselves, are self-employed borrowers, where you act like an independent contractor. Okay, at the end of the year, you report your income based on either whether you're getting cash or 1099. So a lot of times with self-employed borrowers, it becomes a challenge in getting you an approval, okay? And that's where all these different types of programs do end up coming in. The first course of action that I will take is I will always try and qualify you under a full documentation loan. And what's the reason for that? The reason for that is because it's the cheapest money in the market. I can always get you a much lower rate. And today's market rates, the rates have come up some, but today's market rates are upper 3, around 4% at this point. They've come up since the beginning of the year. But you can get a 30-year fixed mortgage under a full documentation loan right around, let's say, around 4% today. Full documentation, meaning credit, income, and assets. Those are the 3 parts that we talked about earlier. But then we have the other borrowers who are not able to qualify full doc. And that's where these other programs come in, what we call your non-QM type products, your bank statement programs. We're able to take average of deposits. For example, let's say you're depositing $10,000 a month. We're able to take deposits and average them over the last year and use that as income. Okay, we can go as far as no doc programs where there's very, very little documentation involved. And really it's based a lot on the property itself, where they'll look at the income and expenses of that property and we qualify you based on that. You have your low down payment programs. In New York, we have Sonny Mae. You can get 100% financing. In New Jersey, we're signed on with the New Jersey Housing Association, where we give you a $10,000 grant, free money that you get as a first-time buyer, or even if you've bought before. There are 2 different programs that we do offer. It's a fantastic program. There are some limitations with it as to how much you can qualify. But nonetheless, if you are having challenges getting a down payment, that is definitely a good product that we can always consider for you. Now, down payment, you can have as little as a 3.5% down or a 3% down on a conventional. FHA is 3.5% down. Very small down payment as a first-time buyer that you can utilize. And even with that, we could still help to get you a grant. And we can also help the seller. We can have an offer put in where the seller can help you cover some closing costs as well. So point is, we will figure out how to make it work for you. And this is a great one, utilizing FHA to purchase mixed-use properties. A mixed-use property is considered a commercial property. And in the commercial world, you're going to be required to put 25% down payment. The nice thing about the FHA, if it qualifies and the residential space square footage is greater than the commercial space, I can get you into that property with only 3.5% down payment under an FHA loan. So that's a really, really nice program that we offer under the FHA. Not for everyone. Again, the property has to qualify, and it's a primary residence only. But for many artists who are looking for that type of space where they can work in their home and have that commercial space, this is a perfect product. And where we see a lot of it is someone that generally will use their property for their practice, okay, or the business that they're in. All right, so definitely keep that in mind. Commercial would require 25% down, which is a much larger down payment. Okay, so we have those options available to you. All right, next slide. Okay, I just want to touch on some roadblocks that just to be aware of that can negatively impact your application. And again, the point of this is to prepare you so that you can go into the process and not have these issues. Okay, so things like communication delays. The process of getting a mortgage takes a good 30 to 45 days. I'm really big on communication. Aretha will tell you, Michele will tell you, you reach out to me, I'm there to answer your questions. My team will be there to answer your questions. At the same token, when we reach out to you as the consumer, we need a response back because it keeps the flow of everything moving. It's very important that there's always that open level of communication between all parties. Cash deposits we talked about. This is one of the biggest challenges that I see is those cash deposits. Be very careful making large deposits that are out of the norm. If you're consistently making large deposits because of your job, that's different. But if you have $10,000 sitting at home in cash and you're ready to buy a house and you throw it in the bank, it's going to be a problem. I won't be able to source it. I won't be able to use it. So just please keep that in mind. Okay. Job changes. This is another one that we always try to tell our customers, please avoid changing jobs in the middle of a transaction. It delays the whole process. It can actually hinder us from even closing, because if you started a new job right in the middle of our process, now we have to wait a good 30 days, if not longer, to obtain pay stubs to be able to average out your income. Now, if you're switching jobs because of an advancement, it's a set, steady pay, like a salary job, that we can generally work around. It's the hourly positions that become a problem if we have to wait that time. And that can cause, issues. If you're planning on changing a job, try and do it before you go into the process of actually buying. Do it as far advanced as you can. major purchases. If you go out and buy a vehicle, you charge up a vacation on your credit card. We see all this. We monitor your credit and your activity throughout the process from the beginning all the way to the end. So be cautious on opening up new accounts, incurring new debt, co-signing for anyone, just taking on any new debt in your name. We will immediately see it because we monitor. We have these systems in place that will pick up anything new that's hit your credit. And that happens throughout the whole process. So be cautious when you're, looking to do that. If you need to buy a car, your car is due to be returned. Just talk to your loan officer. Talk to me about it first. Let's make sure we address the payment on it. I'll say, okay, there's plenty of room to carry this payment. No worries on that. You'll be good to go. Okay. But we just want to make sure that that's addressed beforehand. Changes to sales price or seller assist. When we start to change the terms of the deal, it can affect everything in the transaction. Okay, a real estate agent would have to go back to the seller first of all to get the approvals on this. That can jeopardize your deal. You want to make sure that all of this is addressed from the very beginning. When you're presenting your offer, and there's an attorney review process, okay, which Greg will talk on, you want to have all your stipulations in place at that time. Try to avoid changes last minute, okay, because that can cause problems as well. All right, so just some points to remember there. Next slide, Aretha. Okay, now I'm just going to leave you with, where is the housing market today? I always get the question, is now a good time to buy? And yes, it absolutely is, and I'll tell you why. Rates have come up. They've come up in about 1% since the beginning of the year, which is a big, big jump. In 20 years I do this, I think I've seen it one time where I saw rates jump that fast. Just last year, before the new year, we were selling rates in the upper 2s. Now we're selling rates in the upper 3s, and they're still creeping up, but they're still historically low. They're still very, very low. To get a rate in the 3s today is still a fantastic interest rate for a 30-year mortgage. It's the lowest that they've ever been. And prices today, there's no indication that prices are coming down. The indication is that prices will still increase slightly this year, but they'll stabilize, because when rates start to go up, you'll start to see prices start to stabilize. But there's such a need for property, and there's a lack of inventory, and there's such a, there's no reason. There's a frenzy of buyers out there right now. So there's really no reason for prices to come down anytime soon. So definitely an absolute good time to buy. And you're probably going to see this for the next few years before anything happens. Real estate cycles, but right now as the market's very strong, and definitely a good time to buy before rates continue to go up and prices continue to go up. And HELOCs are home equity lines of credits. And the reason I mention this is because many people that own property, what we're doing a lot of is they're pulling money out of those properties because the values have come up so much, and utilizing those funds to buy more property, add to their portfolio. So if you're an investor, and you already own a home, this is a great way of being able to buy more property. Okay, so that's something else I just wanted to throw in. All right, next slide. That sums it up for me. I just wanted to see if you guys had questions. I know I threw a lot out there for you. Please let me know if you do have any questions. I'll be happy to answer them.
Thanks so much, John. What we're going to do, we're going to ask everyone to save their questions to the end, but
perfect.
We kept slide there just so that, but that was wonderful.
Thank you.
Yeah, thank you. So we will now turn it over to Greg. So let's go to the next slide. Oh, and there's John's information as well. If people want to do, I'll just leave that up for a couple seconds. People can do a screen grab or screenshot of it. Okay. Great. Okay. Well, actually, did I skip one? Oh, this disclaimer slide, right? Where'd it go? Sorry. Ah! There. Wait, sorry. Well, anyway, why it keeps going back. There. Okay, so this is just your disclaimer. John, it has to be there, I guess. So I'll kind of go past that. Okay.
Thank you.
There you are, Greg. Greg Byrnes is an attorney, and he is going to be speaking to the legal side of your transaction.
Good evening, everyone. I'm Gregory Byrnes of Davis Byrnes. I'm principal attorney. We primarily work with residential and commercial, with landlords, tenants, sellers, buyers, and pretty much anybody that's involved with the regular sale and purchase of real estate in New York and both New Jersey. I'd say our primary market is in New York, but we are branching out and continuing to expand into New Jersey. Now, and everybody gets to everybody loves when they get to the point of getting to a contract. That means that their offer is accepted. That means that they are at the point where they can actually buy a sell a property if you're the seller trying to recover funds to go to wherever you want with them. Now, the first part of when you first come to an attorney, this is typically the first time that somebody has ever really dealt with an attorney. Most people have not dealt with an attorney previously in life. This is often a shocking experience, but also often a very pleasant experience, because they know that they are about to purchase a house, a condo, a multifamily building, whatever it is that they are purchasing. They are excited and they're ready to go. So when you first get to us, the first thing that we do is we have an initial consultation. In the initial consultation, we will discuss the property that is being bought. We will discuss some basic features of what's going on with the property. Where is it located? Are there any distinctive issues with the property? Any distinctive qualities of the property that we need to address? And then on top of that, we will discuss fees. Now, I bring that up because some people are a little bit shocked that you need to have this discussion, but as an attorney, I feel like there's an obligation to have that discussion upfront on how much it's going to cost. In New York, you're typically looking in the $2,000 to $3,000 range for a regular residential transaction. It can be a little bit more if the apartment or house is a little more expensive, and it can be a little bit less depending on where you're buying. In New Jersey, so you're typically looking in the $1,000 to $2,000 range for a standard real estate purchase. Now, after our initial discussion, we typically send out what's called an engagement letter. This lets you know that you are hiring us and that we will be compensated at the end of the transaction. Now, depending on the attorney you're working with, this can very much vary, but I'd say at least 50% of the attorneys I work with don't get compensated until the transaction is closed. If it does not close, there's usually a negotiation between the parties. Now, after that, we head into what is called contract. In New York, attorneys draft contracts, attorneys exchange the drafts of the contracts, and they sign the contracts. In New Jersey, the brokers actually start with a form contract, with both parties sign. This is a big distinction because some people are very confused when they go from New York to New Jersey and they get to this point and they don't understand why they're signing a contract with a broker compared to an attorney, which you're going to do in New York. It's just not, it is a very different procedure. That being said, when you sign a contract in New Jersey, you do have 3 days to have a attorney review it and send out an attorney review letter. And the attorney review letter says, we disclaim this contract, we do not agree, but here's our proposed changes to this contract. It's pretty much happened in every contract I've ever done in New Jersey that is the exact letter that comes out. It says, we disagree with the contract. We're going to make changes to it. And then the parties start negotiating the contract at that point. In New York, when you contact the attorney, the seller's attorney will end up drafting the contract most of the time, and then they will send it to the buyer's attorney. The brokers are typically not involved in this process. Now, I would also say in New Jersey, not all transactions have an attorney. Often in the southern part of New Jersey, and I'd say it's probably starting at about the Point Pleasant and down, maybe a little bit south than that, and that when attorneys are not involved in these types of transactions, you will deal solely with what's called the title company, and we will discuss the title company a little bit later on, and then what they do. Next slide, Aretha, or 2 slides ahead.
It's 2, right? Thank you. There.
Okay, so the contract is the most important document that you're going to see during the transaction. The contract outlines pretty much from start to finish everything that needs to happen. It outlines the parties, the terms, and how you're going to get to closing. It is very important that this contract is negotiated, or the terms of the contract are negotiated early on. If you do not negotiate them early on and you do not have your terms in the contract, you can't turn around to the other side and say, hey, we need to change this. You need full approval from them to be able to do that. And oftentimes, I'd say years ago, before COVID, you had a little bit more better ability to negotiate a contract after it was signed, but now it is very difficult to negotiate a contract once you're in it. Oftentimes sellers will not give concessions, because sellers will not give any benefit to the buyer, because they know that they could turn around and sell to somebody else. And on top of that, they know that you've already probably put down a deposit on the contract to be able to be there. So it is very important that you take the contract seriously, you review the contract, and you know that you understand the terms of what are in the contract. Now, I'd say the most negotiated, discussed part of a contract are the contingencies that go into it. The most common one you'll see is a financing contingency. This means that you are able to go out and ask a bank to lend on a property. If you do not have a financing contingency in the contract, you will not be able to say, hey, I can't afford this property because the bank won't give me any money to be able to buy it. If that is the case, you will not be able to back out of the contract. You will not be able to back out of the deal, and you will be unable to close. You will lose your typically you will lose your down payment at that point. It is not a place you want to be. But in this current market, I see a lot of people that are waiving their financing contingencies. They are putting up larger down payments. So there is a lot of risk if you are not able to get a loan. So as John discussed, pre-approval is very important, and being able to actually close that loan and purchase the property is very important. Some of the other common contingencies you'll see in a contract are inspection contingency. An inspection contingency means that you will be able to bring a professional inspector, or even more recommended, an engineer into the building or the apartment or the house, and be able to look at the different aspects of it and assure you that you will not essentially need to make any capital improvements into the building. If you are in New York, one of the big things that you need to look for, especially if you're looking at a condo or a co-op, is for lot line windows. Lot line windows are windows that are sitting on the property's edge, which may or may not have a building next door. This comes an issue if a building is built next door and covers up your window. You all of a sudden may lose a bedroom, and it no longer may become a legal bedroom. When that happens, you also lose a significant amount of value in your property, in the apartment, when you do that. So make sure that you do not have any lot line windows. Often you'll also you'll have them look at an HVAC system if you're in a house, roof, and if you're in either a building or a house, you still want to know what the roof is, because there could be some assessments that come along with that, and we will get into that in a little while. Also environmental. A lot of people buying in the suburbs have to deal with environmental issues. Environmental issues are everything from oil tanks that are in the ground, which could cost tens of thousands to hundreds of thousands of dollars to remove, to say airplanes flying overhead. Say you're in Flushing and LaGuardia, airplanes could be flying over. That's something that you want to understand, whether that's rounding out, whether you could pull out for some of these in a contract. That is what is written into your contract. So you want to pay attention that ends up in your contract. Okay. Now, onto the types of properties. There are three. You have a cooperative, a condominium, and single and multifamily. These are the most common and the most common for residential. Cooperatives. These are, you don't actually buy any property or land. Typically, when you buy a house, you are going to get a deed to that property, which is a right to the land that is there. In a cooperative, you actually buy shares in a corporation, and you are giving a lease for the space. So that means you do have a landlord. You are not actually leaving renting. You are still becoming a renter, but you do have, there are different, I'd say, different stakes of value. You have different abilities to be able to control what's going on. You also have a say in how the building is run because you are a shareholder. You will comment, you will have board meetings, you will have shareholder meetings. You will have an opportunity to become a board member if you are voted in. So cooperatives also are not very common outside of New York. Cooperatives in New York are considered almost an equivalent of owning a regular real estate or condominium, a house or condominium. Outside of New York, they are not considered very solid assets. Typically, it is harder to find financing on cooperatives. It is harder to obtain what's called title insurance. And again, we'll talk about title insurance later. So cooperatives can be a very solid asset in New York, but outside of that, they are skeptically looked at. Condominiums are similar to cooperatives because they are also typically in buildings. They are typically apartments, but the difference is you do get a deed from them. You do not have anybody that is controlling a lease on the other side that can terminate your occupancy. Now, that being said, you also do have a board of managers or a board of some, the name depends on what the co-op, the condominium, but they do run the maintenance. They dictate the terms of the building and what's going on, the common areas and how you use it. So if you're using your apartment and your dog is barking all day, somebody will eventually complain to the board, and the board will eventually send you a letter saying, hey, your dog needs to stop barking or else we're gonna basically sue you for what's going on there. So again, these condominiums are more commonly seen today, or at least more commonly being built today. Cooperatives are very rarely being built today. Everybody is pushing for a condominium because they want that deed and they want a little bit more longevity, a little bit less control by the people in the building. Single and multi-family buildings, the most common or the most relevant here are probably single family houses that you're going to see. You'll see these in Staten Island, a lot more in Staten Island. You'll see a lot more of these in the eastern parts of Brooklyn and Queens, and then the northern parts of Bronx. Single family houses, you're typically the only person that lives in it. Sometimes they are also row houses, so they're right up against each other. You do get a deed for these, and these are probably also the most expensive of the three that we're talking about to buy in New York City. These are also probably the most common you're going to see in New Jersey as well. Once you get outside of the eastern part of New Jersey, it is mostly single family houses that you're going to find, that you're going to buy. Okay, next slide, Aretha. Okay. When you purchase, you generally only have three options on how you're going to take title to the deed, the shares, the lease. The first one is joint tenants. Joint tenants, and this only applies when you have more than one owner. If you have a single owner, neither is why you're just a sole owner and you're the only person on the deed, you own 100% of the deed. Now, if you're purchasing with somebody else, you're going to have to choose whether you're going to be joint tenants or tenants in common. If you are married, you're typically going to be what's called tenancy by the entirety. Now, starting with joint tenants. Joint tenants means that each person is going to buy this house. They are going to take ownership and they're going to have an interest in the property. But when one of them passes away, the interest is going to pass to the other. So if John and Jane purchase a house, they become joint tenants. They both occupy it for 20 years, and then John passes away. As soon as John passes away, the interest in the house becomes Jane. She now owns 100% of the house, and she had to do nothing. She did not have to go to court. She did not have to go to probate or have an administrator appointed. Just the interest in the house just became hers. If they were tenants in common, John's interest would pass to the estate, which means that it would need to go to probate, and then somebody else may own that house. The other distinction between those two is tenants in common. Generally, you can split the property and say one person is only allowed on this part of the property and the other person is allowed on the other part of the property. That generally doesn't happen with joint tenants because the interest will pass together and they will be owned together. So you will see tenants in common more in an investor situation. You'll see joint tenants in generally a familial situation. Tenants in the tenancy by entirety is basically a form of joint tenancy, which means, but it can only apply to people that are married. And you'll see in the deed that it'll say Jane Doe and John Doe, husband and wife. And in tenants common situation, you'll see Jane Doe and John Doe, tenants in common. And then the joint tenant is going to be Jane Doe, John Doe, joint tenants. The standard, if you don't write any of those, is typically joint tenants. Next slide. Okay, so now we're through the contract. We're through contract. We've had the contract signed. Now comes the point where we're getting into due diligence. First, when you're in contract, you're going to, typically in New York, you're going to have a point in the contract where it says, if you're buying a single family house or multifamily house, it's typically going to say that the seller is waiving their property disclosure and will give a $500 credit to the buyer. So what this means is in New York, there is no, in New York, there property disclosures, somebody's microphone is on at the moment.
I turned them off.
Oh, thank you. Okay, so property disclosure. In New York, if you do not, in both New York and New Jersey, there is a form property disclosure that everybody is supposed to fill out. However, in New York, the penalty for not filling out the property disclosure is a $500 credit to the buyer. So I have yet to see a seller actually sign a property disclosure. Now, the reason being is a $500 credit is a lot less than the potential litigation that may result from misdisclosing or failing to disclose something on the property disclosure, or possibly breaking up a transaction or a sale because something on the property disclosure was raised that wouldn't have been raised if not for that property disclosure. So typically in New York, if you were buying, and this is restricted typically, and it does not apply to condos and co-ops, is a $500 credit in the contract. In New Jersey, that is a different situation. In New Jersey, typically it is done with the brokers before it even gets to the attorney. And I've yet, typically they do come in, and there are very few that actually do not get executed, which brings us into the due diligence period of contract. Once you're out of contract, you go into due diligence, and you can go to the next slide on this. But due diligence is when we're investigating the property and finding out all the flaws that are with it. This is when, and again, this depends on what market you're in, whether the inspection is going to occur before contract, typically during when you're making your offer, or about the time you're making the offer, or after. When it is a buyer's market, you could typically get due diligence after you're in contract, and you can get an inspection contingency. Inspection contingency can be very important, and inspecting the property is very important. You want to know all the flaws in the house or the apartment, or wherever you're in. Now, a lot of the typically, as we said before, you're going to hire an engineer. You're going to hire a certified inspector to do this. They will go through and they will look at all the different foundational issues, HVAC issues. They will look at appliances. Oh, sometimes they will look at appliances. But the big things that are going to consider are the capital improvements to the building. They want to make sure that there are no major issues that will cost you a ton of money in the future. Now, while we're in due diligence, we also want to, and if you're in a co-op or a condo, look at the condo association or co-op board to see what are the financials like. Now, in condos and co-ops, you would typically have to pay a maintenance fee every month. Sometimes they call it rent. Sometimes they call it any other term, but you are going to pay a fee every month for the common areas. For in case of co-ops, you're also going to be paying taxes every month. You are also, there's finances that go, so there could be a loan for the building that's there. So typically you're going to want to pull the finances for the building, and typically you send a letter to the board who runs the condo or co-op and request that they give you the financial statements for the last typically 3 years. You will want to review those statements, and you will want to see whether they are financially solvent, because typically you will see if they are not financially solvent, there is a very, very good chance you could be receiving assessments in the future. And an assessment is a one-off charge for, say, to replace the roof in the building, or to pay off a loan, or just because it's starting to incur debt because they're not collecting enough maintenance from everybody else in the building. So you could potentially be responsible for paying off assessments from mismanagement in the past. Now, I would say these are probably more common in co-ops versus condos, but you will definitely see in both instances. And sometimes they're a couple $100, but sometimes they're also a couple $1,000, and they can be very detrimental to some people. And lenders also want to see this as well. Lenders typically want an understanding of whether all of a sudden there is going to be a several $1,000 assessment, or there is an issue with something that needs to be addressed. So we would typically request that the seller provide any information they know about a potential assessment, and we will also request that the board certify a letter saying that here are our finances, we are in basically good financial shape, and you won't see any issue. You would also want to confirm the maintenance or the rent that you're going to pay. So you will typically include this in the contract, but you also want to confirm it with the board as well. You want to confirm that everything in the contract is actually as it says in the contract. Okay. During due diligence, if you are buying a single family home, you're also going to want to have sometimes have a survey performed. A survey is looking at the boundaries of the property. They want to make sure that the boundary lines are correct, and that there are no encroachments or a house, say, sitting on your property. It's actually quite common that the lines to property lines are not accurate, or I'd say that somebody has built property that is over the boundary line. You'll typically see fences that have gone beyond the boundary line. You'll typically see garages that have gone over the boundary line. These aren't necessarily detrimental to purchasing or an issue that will come up. Often what times is you'll sign a boundary or ask the seller to get a boundary agreement with the neighboring property saying, here is the boundary. And the terms of that can vary from house to house or deal to deal, but it'll often say that, no, we're not claiming that is actually our property. We may move our fence, or you may lose your fence, but that property does belong to you. This can impact title, and that is something that the lender may or may not raise depending on the lender's criteria. Some of the other things that you're going to look at during the due diligence period is an environmental report. An environmental report, as we discussed earlier, there can be the most common thing that I think you're going to find or want to have looked at is oil tanks. You'll see you'll have what's performed an oil tank sweep to see if there is an oil tank in the ground. If there is an oil tank below, then the question is whether it was leaking. If it is leaking, that is a very complicated process and expensive process to remove. So if you do get to that point where you're looking to see if you do find an oil tank on the premises, that is a big red flag that does need to be addressed, and either the seller needs to typically put up money in escrow pending the removal, or some type of confirmation that it is acceptable to leave in the ground and it is not leaking and not going to be an issue. So that is probably the most common environmental issue that does come up in a single family or a multifamily sale. Now, last, while all this is going on, you're going to hire what's called a title company. A title company, actually, I think this might even be on our next slide. Actually, no, it is not. Okay. A title company looks at and determines what is the history of this property? Who have been the owners over time? They will look at the previous owners and they will try and trace who purchases over time and make sure all those transfers were correct. They will also often hire the person who's going to survey the property, and then they're going to, in the end, if you were buying typically a condo or a single family home, they're going to issue a title insurance policy, which the lender will require. Almost, I don't think I've ever seen a residential purchase without a title policy. And the title policy will ensure that all that title is correct. So typically when you close contract, you will send you will speak to a title company, or the attorney will speak to a title company and they'll say, hey, we need to order title for this property. When that happens, they will start researching the property and they will put together what's called a title abstract. In the title abstract, you'll have what's called Schedule B. And Schedule B says what we will not insure against this property. There are certain provisions in there that say we will not insure against minor intrusions against the property. We will not insure against known issues with this property. So in the event that after you close and you own the property and somebody comes and they commence a lawsuit against you and they seek to have ownership or seek to get damages against the property, the title company will step in and they will insure and they will pay out on it. They often control a big aspect of the transaction, especially if you were in New Jersey, especially in the southern half of New Jersey. Title companies often will control the entire transaction from beginning to end instead of using an attorney. In northern New Jersey, they are still involved since contract to closing. They will be typically at closing, or they will have involvement in closing, even if they don't have a person at the closing. So title companies are very important. And lenders typically will not lend if a title company will not insure the premises. Okay, next slide. Let's go on to closing costs. Closing costs can be a large amount. I'd say typically you're looking in the 3 to 5% range of how much they're going to cost, how much it's going to cost. The most common one that you're going to see, and the seller is typically responsible for, is a transfer tax. New York and New Jersey haven't. New York City has an additional transfer tax, which is much more expensive. And on top of that, there is a mansion tax in New York if you are over $1 million. The seller typically pays the transfer taxes, but if you are buying for over $1 million in New York, the buyer is typically responsible for that. If the seller is responsible for that, the price on the property actually is considered higher than what it is listed in the contract, and they will have to pay an additional expense on top of that because you are shifting a burden that's typically borne by the buyer. It is very rarely transferred over to the seller and is typically carried by the buyer. Now, the other closing costs. Now, you would typically not be responsible for the transfer tax, but the mansion tax. The next point is you will be responsible for bank fees, any points that you're going to purchase on your mortgage, and title fees. Title fees tend to be, are based on the cost of the property. They are typically a percentage of the property plus certain filing fees along the way. The insurance policy that comes with it is by far the most expensive part of the title insurance. If you're buying a, say, $500,000 house, you're probably looking at a title insurance policy in or around $2,000, give or take, depending on New York versus New Jersey. They are dictated, the cost of that is actually dictated by statute. I don't have it in front of me exactly what it would be, but there is a certain cost to that. And typically when you go to a title company in the beginning, they can tell you how much their title fees are going to go in the end. They have a closing statement that they can give you right away to tell you you're going to pay an estimated, say, $6,000 in title fees at closing. Next, you're also going to pay mortgage recording fees. New Jersey does not have these, but in New York, you do have these, and they can be up to almost 2% of your mortgage. It is rather expensive to borrow money in New York. In addition, You will have attorney's fees, and you will also have some miscellaneous fees in there. So I'd say you want to prepare. I'd say you want to have at least 5%. I'd say probably closer to 10% of the purchase price in the bank, if possible. I'd say you're not going to get anywhere near 10%, typically in closing costs, but there is the occasional issue that does pop up, and you do need to cover, say, additional work that needs to be put on the house, or say the appraisal comes back below cost, and you do need to put up some additional money in the end. So you do want to have some extra money in the end when you do get to the closing. Now, when you do get to closing, there are typically two ways that you do it. You do an in-person closing and a mail-away closing, or escrow closing. An in-person closing is usually schedule it, and the buyer and seller show up along with the title person, along with a representative from the bank, and sometimes the brokers even show up as well. So you could have up to 8 or 9 people at the closing. I'd say since COVID, these are becoming rarer and rarer, and I would say eventually they are not going to be very common anymore. Closings typically are 1 to 2 hours, and they are rather high paced. You will see a lot of documents that are passing between parties. You will see people, you will see so very little negotiation at these things. It's typically just making sure that the documents are in order and how they are supposed to be. So if you get to a closing, there should be not much that is being done other than just making sure that the documents are in order when you're there. If you are negotiating and end issues, that is typically a problem, unless you're dealing with a final inspection and say you walk through and there's an appliance that's not working. Oftentimes, if there's an appliance that's not working, you'll give a credit to the buyer at that closing. Now, also one thing that you need to do, which I probably should have addressed before this, was before you typically get to closing, you will also have to do what's called a closing statement. You cannot close unless that closing statement is done 3 days earlier, or at least started 3 days earlier. Typically, the bank attorney or the title company will issue that closing statement. The closing statement is very important because according to law, you cannot close without doing that statement. It's technically illegal unless there is unless there is a waiver between the parties. And most lenders will not let them close unless that closing statement is done. So that is very important to get done before you get there, and make sure that everything is accurate. That's one. And you cannot also change that closing statement once you get the closing. If you don't, there is a process to be able to waive, but typically you'll have to wait another 3 days to be able to close. So it is important to get there. And then once you're done, everything is signed. It is a not nearly as dramatic a moment as most people think. Everybody walks away and say, okay, now I own a house. Now what? Now we got to clear the closing. And most people think they're going to walk away and it's going to be, a big celebration. Typically everybody kind of just walks out and they go along the business. Now you own a house and that other person took home a large sum of money. It's just on to that. It's on from there. That's it. Time to go live in your house. Time to go get the keys from the broker or whoever has the keys at that time and move in. So I think that's it for me at this point. Now, I guess we're going on to the question and answer portion of this.
Thank you so much. That was great. You guys covered a lot. The one thing that I did want to mention, which is important to know, and then we'll get into the questions, is that extra cash to have after closing. Oftentimes, if you're purchasing a co-op or a condo, they require that you have X amount of months in that maintenance or common charges after you close. Like, you really shouldn't be closing penniless, right? So they really want to see that. So that's just something for you to plan around. But the good news is, if you are borrowing money, you don't close within a few minutes. It takes a few months. So the snapshot they took of your bank accounts and your statements and so forth, when you applied for the mortgage initially, those numbers should have changed to be more advantageous for you, because you would have had 2 or 3 months to accumulate more money. So you should be okay. And that's just something that I always try to remind my buyers, like, we're not closing today. We're just, submitting the offer. So you do have some time while you're in contract, you're still working, you're still making money, you're still saving. And, you know, if you're following John's advice, you are not buying a car or any large, going on any vacations during that time.